Hey, what's up, everybody? Welcome back to another episode of the Liquid Lunch Project. I am Matthew R. Meehan, alongside my partner, the professor, Luigi Rosabianca. What's on tap today, Lou?
Matt, you said it couldn't be done. You said I couldn't find him, but I did. I swept long and wide. I searched the country, and I finally found a CPA who is also an entrepreneur, the unicorn. Welcome to the podcast, Sean Graham. Sean Graham has an illustrious career in CPA and tax accounting stuff. But he's also a wonderful real estate professional, entrepreneur, focused on self-storage spaces. And then he realized there was a wonderful opportunity within that real estate world for cost segregations. Today, we're going to have a wonderful conversation talking about his journey, as well as how cost segregation is a powerful tool for your small business. Sean, welcome to the podcast.
Thanks for having me here, Lou and Matt. I can already tell this is going to be the most fun podcast that I've gone on, so I'm happy to be here.
Well, let's put some truth to that statement. We appreciate it. So how did this begin? How does a humble CPA develop that entrepreneurial zest?
Yeah, that's a good question. I think it was, honestly, I think it's more reverse those two, the order of that, right? I think I've always been an entrepreneur, like in spirit and at heart. And I've always thought about what I can go out and build on my own, right? And so I was like in graduate school, in like master's for accounting, you have electives. You got like one or two electives. I'm the only accountant who's taking like the entrepreneurship elective, right? And everybody else is like, what are you doing? Like, why are you taking that? But that's just always been my path. I think I went down the CPA accounting path because that's the language of business. Like to me, that's the most difficult thing to learn and to understand are the numbers, the financials, the projections, the pro formas, the, forecasting, budgeting, accounting, all of it. So I figured if I can go down that route and I can learn that, then I have a leg up as opposed to just going down a different path that might be more natural for me immediately, if that makes more sense.
That makes total sense because you can apply that skill set in accountancy and forecasting and cash flows to any business as you've done.
Yeah, exactly.
So then once you did have that wonderful acronym after your name,
yep.
What made you get into the real estate space?
Yeah, so I was always looking at houses. I was always looking at properties, trying to figure out, okay, how do I make this work? Eventually, I think like a lot of entrepreneurs, I read Rich Dad, Poor Dad, and it's not a real estate book, but it was like they talked a lot about real estate in that, and
you could admit it. You had Monopoly as a kid.
Yeah, I had Monopoly as a kid. I always loved Monopoly. I discovered Bigger Pockets, all that. I think honestly, it's the easiest entrance into entrepreneurship is through real estate, and in my opinion, because you don't have to like recreate the wheel. You don't have to invent something. Like you can go buy a rental property, right? And that's an entrepreneurial endeavor, and anybody can really go buy a rental property, right? And so that's where I started off. Is I was in the W-2 world. I was in accounting and finance, but then I started building up my rental portfolio on the side.
But it seems like in building that portfolio, you had kind of figured out this blueprint using FHA-based loan products. Kind of walk the audience through how that works and how you leverage that.
Yeah, I've always been, I've always really liked leverage. I believe in leverage, and obviously I believe in like being intelligent about it, right? And making sure that the leverage you're using, you can get a higher return on it than you are paying in terms of like the difference, the spread between the interest rate and what you can get as a return on your investment. But FHA is like a great product. So like when I was in my mid 20s and I'm trying to get into real estate, I didn't have a lot of capital, saved up. I think I graduated, I went to grad school immediately after, so I'm already late to the game getting into the W-2 world. paid off my student loans all at once. So I didn't have a lot of capital saved up. So it's like, okay, well, what can I do? How can I get in? And the FHA thing it's really a great product. So, you put 3.5% down, you have to live in the property, but then you can rent other units out. So I bought a 3-unit building. It was around $400,000 and lived in one unit, rented the other 2 units out, did some rehab, fixed it up a little bit, raised rents, refinanced out of the FHA loan. And then I stayed there 2 years, and then I went and bought another one with another FHA loan. And so I did that multiple times. And it worked really, really well.
And then how did you segue into the self-storage space? Because we've heard, Matt, what's it been now? The last decade or so? Like self-storage is it still hot? I mean, it was like the talk of the town for a decade.
But was it hot only because rates were so low and everybody was diving into it? Now they're having a hard time
Oh, good point.
refinancing out of these loans that they're in.
Yeah, I think that's accurate. I think that's accurate for, probably a lot of different asset classes. But self-storage also offers, there's ways to leverage self-storage like pretty highly, right? So you can get self-storage looked at as a business. It's technically a business, right? So you get the benefits of real estate, but you're really buying a business. So I used SBA loans to enter into self-storage. So I'd get partners, I'd use SBA loans. We have a lower down payment. It's a good way to get in. Those are great because, when I was buying them, though, interest rates were a lot lower than they are now. That's very true, Matt. So you're talking about like 4 or 5% interest rates, and now they've doubled because of where we're at economically. So it's not as attractive.
You mean it's not interest only forever?
It's not interest only forever. No, it's not, unfortunately. So those were good. Those are good products. Self-storage is still hot. I would say it's definitely still hot, but the margins are a lot tighter. It's a lot harder to get the right deals done, or you just have to bring a lot more capital to the table in order to make the loan make sense. So that's what I wanted to get into commercial real estate. So it was like, okay, well, I think you just kind of have to choose an asset class. You can be successful in whatever asset class you really want to. If it's multifamily or storage or whatever it is, I just chose self-storage because it's the simplicity of it. It's not a difficult business to run. You can run operations remotely. You need a really good boots on the ground maintenance guy, but there's softwares and stuff where you can operate them from anywhere.
Now, do you actually do any apartment buildings, or are you strictly self-storage?
Strictly self-storage. I mean, I have small multifamily too.
Okay.
Like, duplexes, triplexes, but like it's all self-storage on the commercial
So
side.
when you're running these deals and you're putting them together, are you using a simple GPLP structure?
Yeah, so I did a couple using JV partners. So, hey, let's just,
Okay.
we're all going to be on the loan. We're all going to split ownership or, equity based on either the capital contributed or the sweat equity. So for me, a lot of it was like the sweat equity part. I was running the deals, finding the deals, getting through underwriting, the whole 9 yards, and then going out and putting, the right structure in place to manage the properties and to improve the properties. And then have partners who come in and, they might be able to help from a marketing standpoint or different standpoints, but primarily they're coming in for like as capital investors. And then I started doing some syndications as well. So syndicate, LP, GP partnerships. So limited partners would come in and we'd raise the capital, either 506B or a 506C syndication.
Sean, what's the Goldilocks geographic zone for these self-storage? Is it immediately outside urban centers? Are they off of major interstates? Like what was your formula that worked for you?
So I think I like the secondary markets, where we're not talking about in the very, like, if you're in the city of Chicago, you're gonna have to, like, that's pretty difficult to compete with. You're competing with all the REITs and stuff, but more
Sure.
the outside of that, like in the suburbs, in the, you try to get in the path of progress in developing areas. It all comes down to a saturation level, like supply and demand, right? Like, and that's like anything else. If it's multifamily or whatever it is, it's all saturation level. So You kind of look at every single property on a individual basis, and I think the majority of tenants or customers are going to come from within a 10-minute drive or probably a 3-mile radius. Like that's going to be the majority of your customers. So
Sean, I'm asking for a friend. Do you have anything in the Orlando area? I've got a buddy of mine. Every time you open his garage, everything falls over you.
yeah, is that Matt here or is that somebody else?
Asking
No,
for a friend.
hey, listen, I cleaned out my garage on Sunday again for the third time this year already. And I do have a
And he
storage
still
unit.
can't park his car inside.
Matt, I've
I
got
can't.
somebody who can build them for you down in Orlando. So as soon as you're ready for that,
Now, listen,
you know,
they're going up. They're going up everywhere I look, especially like when I moved here 10 years ago, there were no houses. And just listen, we just accumulate things. It's not just me, it's
So,
everybody in
gents, what
America,
is the
right?
market for self storage? Is it for the head of household that has no space left in the attic, or is it for the business owner that has excess inventory? Or I've also heard these rumors about like these really boutique type self storage where their refrigerator and you could house
yep.
your wine collection, or you can. I mean, where does that trend end?
Yeah, there's like car garage storage, right? Like exclusive like what vehicles, very like high-end storage. There's boat storage that's like right on the water where you kind of have your own space and you almost own like condo garage type of storage, right? There's wine storage too, like cold storage. There's all different niches. So I don't know. I mean, just basic self storage, whether it's just either drive up non climate controlled or climate controlled, I would say it's primarily for people who are moving. That's where the majority of customers are coming from. So storage is a lot more difficult when interest rates are really high and people are not buying and selling houses as much because the demand goes down a lot. Um, a lot of times people move, right? Or they're moving and they get a storage unit and they keep it for like a very long time. They'll keep it for months or for years, right? And so I would say that's where the majority of the demand comes from. It's beyond that too, right? We just have a lot of things. I mean, you can like you said, your garage is full, and I'm sure you still have Amazon boxes coming to the house every day, right? Like everybody does.
Listen, what's in my storage unit is a lot of stuff from my grandfather that nobody wants to come down and get. I can't keep it in my house. There's no room for it. I just can't find myself throwing it away. So I pay a few $100s a month just to keep it there.
Yeah. What do you think it's worth?
My grandfather's stuff, I don't know. It's more personal items, more
Okay.
family
More
pictures
sentimental.
and
Yep.
stuff. Yeah.
Yep.
Yeah.
Yeah, it's funny what people will
No.
store, right? They'll store stuff that's maybe not even whatever. It might be worth $500, and they'll store it for years and pay way more than that $500. And sentimental items are different, but some people just, I don't know,
No, there's waiting lists by the storage units by me.
really,
Hmm.
that's wild.
So,
Yeah.
Sean, we cannot have this conversation about real estate and self storage without talking about the wonderful tax benefits of real estate.
Yeah.
Oh, that's my favorite thing in the world. Can we talk about it? Can we talk about cost segregation? I love
That's
it.
why Sean's here today.
That's so funny. Yeah, of course. I mean, but I think taxes are the biggest enemy of anybody who earns a lot of money, right? Who you're a high income earner, taxes are that's their biggest expense. So there's lots of different ways to offset taxes, but what I focus on is real estate and specifically how to utilize depreciation to lower your taxable income. It's a very real strategy. It's a strategy that like people who understand it and are in real estate, like they utilize it, but a lot of people don't because they're just not aware of it. um, but it's important. I think it's one of the most attractive things about real estate.
Sean, just to be fair to everyone, I'm guessing that 98% of the audience is very familiar
Sure.
with cost segs and probably has put one in place. But for
Okay.
those 2%, can you just give us a elevator pitch on what a cost seg is and how important it is to apply it to your portfolio?
Yeah, of course. So the IRS looks at real estate as a passive activity. And so you are required to depreciate your real estate. So what that means is that the IRS says, well, hey, you have this building, there's going to be wear and tear on the building. And over time, the building, the value goes down because of that wear and tear, right? This is all hypothetical. And so you have to depreciate your real estate. So if it's residential, you're depreciating it over 27 and a half years. If it's commercial, then like self-storage or office space or strip malls or whatever, like then it's 39 years. So the IRS requires you to just straight line to depreciate it. It's just typically over straight line if you don't do a cost seg study over, about 30 or 40 years. This is a phantom expense. It's not a real cash flow expense. It doesn't hit your bank account. You're not like, if you have a $275,000 rental property and you're depreciating it over 27 and a half years, you're taking out 10 grand a year, right? There's not 10 grand a year coming out of your bank account, yet the IRS lets you lower your taxes by $10,000. So that's fantastic. The problem is that like, you're not going to keep it take 30 or 40 years is a long time to wait. So with the cost segregation study, what we do is an engineering study, and we say, hey, IRS, like actually, it doesn't take 30 or 40 years to depreciate this property. In fact, a lot of it could be recategorized into 15-year life, some of it 7-year life, some of it into 5-year life. And in fact, because of bonus depreciation, a portion of it can just be written off in year one. So it's a time value of money strategy where we're front loading the depreciation into the very early years to get those benefits up front.
Okay. So according to that bar napkin math, it would probably make sense for an entrepreneur or small business owner to take advantage of a bonus depreciation during a year where he or she had taxable income. You had a good year.
Yeah, absolutely. We could get into different strategies. I think first off, it's important to note that the IRS looks at real estate as I mentioned, as a passive activity. And so depreciation is a passive loss. That means that the passive loss can offset passive income. So real estate depreciation offsets real estate income. Real estate depreciation expenses offset real estate income. So you can use these depreciation losses to offset your active income too under certain exceptions or scenarios. One is if you're a real estate professional. So like you are in real estate full-time or at least 750 hours more than anything else. Could also be your spouse. So like maybe you work full-time, but your spouse manages your rental portfolio, right? Like then you could qualify for real estate professional status. Fantastic. You can now use those losses to offset your active income. So you'll see like a lot of physicians a physician is building the real estate portfolio in terms of like they're making the money, but the spouse is the one who might be managing the real estate portfolio. And so they're a real estate professional. They utilize these losses. So that's one strategy. The second one is short-term rentals. Short-term rentals, if it's average stay is 7 days or less, you materially participate, well, then it's not considered passive. It's an active activity. And so you can use it as the depreciation as active losses. So you'll see, again, like doctors or high income earners who buy short-term rentals, manage them, and then they can use those depreciation losses to offset their active income as well. So that's the second one. Third one is just like business owners. Like maybe you're the same. We'll say a doctor, you own the practice, right? Or you're a business owner, you own a shop. You can get a cost seg study on your building, use those losses to offset your business income. So those are the three like main buckets or things that I like to talk about. Lou, I'm trying to go remember exactly what your question was because there was a reason I pivoted to that before answering your question.
You answered it so well. You actually answered the next 3 questions. So fantastic. Thanks, buddy.
I'm sorry. I just fast forwarded the interview there.
So you just proved to all of us on how you've mastered this because you made something very complex sound simple to amateurs like us. So thank you for that explanation. This cannot be easy for a simple investor like Matt or myself or someone in the audience to do. So how can a real estate investor engage Maven Cost Seg to do these cost segs and kind of walk them through what the process is like, right? Is it like an online portal? Is it a site visit? If someone has this need for a cost seg, how does one achieve it?
Sure. So we only do detailed engineering studies, which means like we're actually breaking down the components of your specific property. So, you'll see things out there. You'll see like DIY cost seg, which is not by an engineer. It's like, hey, you put in the information, you have like the liability, responsibility, you're doing it yourself. Right? If you don't know what you're doing, it's pretty high risk. In terms of like high risk in terms of doing it incorrectly, I should say.
Okay.
You'll see other companies, they'll do like modeling studies. So we'll say like, hey, I've done a lot of single family homes. Typically about 20% gets reallocated from 27.5 year life into shorter term lifespans. So we're just going to take these percentages and slap them on your property, right? As if it's just a modeling study. It's just statistical modeling. That's another way. We don't do that either. So what we do is detailed engineering. So we say we look at
Matthew, by statistical modeling, he's referring to a hack job.
I didn't say that, but yes, that's definitely one way to term it. It's expediting, it's fast forwarding, it's not doing the actual detailed engineering work, right? And I'm not saying that like that's necessarily wrong. It is a method of depreciation, but it's not something that I would recommend because it's not. It's very likely to be incorrect, right? So that you want to get it. Ideally you want to get the cost segregation study, the engineering study done.
Sean, you're never going to get an argument from us. We don't want an audit. We don't want to piss off the IRS. Those guys are like mafiosos. So we want to do this the right way. We want to hire Meehan. Just explain to us how it's done and we'll pay you for it.
Yeah.
Hey, speaking of paying for it, I imagine there's a cost to this service.
Sure. Yeah.
Is there some way we can kind of twist your arm to offering some sort of preferred pricing for our audience, please?
Yeah, I'll create a discount code for your listeners. So I'll have my team set it up afterwards. If they go to mavencostseg.com/liquid, then there'll be a discount code on there for your listeners. So
awesome.
I'm going to set that up, and then I'll put in like a 10% discount on there for the audience. But it's simple. First of all, there's no cost to getting an estimate. Like an estimate is free. So if you can give us your basic property information, like address, if we can get an online listing or photos, and we know how much you bought it for, we can give you a pretty accurate estimate in terms of like how much depreciation you would expect. Plus, we'll give you the cost of the study. You'll see your return on the investment, and then you can decide, do you want to move forward or not move forward? So there's no charge in doing that. I don't charge tax planning, right? So everything that we're talking about right now, I'm happy to talk to people about because I don't make money with tax planning. I talk about this stuff like depreciation and real estate and use this as a way to, like, I make money through doing cost segregation studies. So all of this just leads into cost segregation. So I'm happy to talk to customers. There's no charge for that in terms of how to utilize these losses or what it would look like on your specific property. And then that gives us an opportunity to present it to you, and then you can move forward if you want. So with the detailed engineering, we're breaking down the components of your specific property, right? And so like we pride ourselves on quality. That's like my main thing is quality. We're not trying to fast forward. We're trying to do this correctly. We're trying to do it right, and we want to take our time doing it because at the end of the day, it really comes down to diligently going through the property and pulling out as much as possible in a legally, compliant way, right? So with residential properties, we'll do everything virtually. So we're not going to do an on-site visit like with a single family home or a duplex or a triplex, unless it's like this, multi-million-dollar property that like really makes more sense for us to go on site and do it. Typically, we're doing everything virtually. So we do it that way. And then for commercial real estate, anything including multifamily, like large multifamily, self-storage, office space, whatever, like we're going to go on site, we're going to do the engineering work. So if you engage, what happens is you submit a form to us either on our website or you shoot me an email, Sean, SEAN @mavencostseg.com, and we're going to gather your property information. I'm going to get an engineer involved right away. We're going to get you an estimate. We'll have the estimate back to you in a couple days. We'll give you a proposal. We'll say, here, if you'd like to move forward, this is how it works. And as soon as you sign the proposal and get the pay the deposit, which we take half up front, half upon completion, then a project manager is going to be on board like immediately, and then tell you the next steps. And hey, this is the information we need to collect. And then we pride ourselves on quality and communication. That's what our foundation is.
I love cost segregation. I've used it myself, but I have some questions for you. Maybe you can clear up. So let's use an example here. Let's say I buy a $600,000 property, right? We're able to find the cost segregation comes in at 20% of that 600,000, right? So on that 600,000, we now have $120,000 in savings on the cost segregation. That's going to lower my cost basis, though, correct, on the house?
Yeah. So I think what you're getting to is called depreciation recapture. I think that's what you're getting to. So, yeah, I was just talking to somebody right before this call. Right, he has all these rental properties, and he hadn't done cost segregation studies on them, so he's got 9 of them. We're going back and getting him. They're small single family homes, but we're going to get him $300,000 plus of depreciation on these, which is going to say he's in the top tax bracket. It's going to save him over 6 figures of taxes, right? A tax impact. So really big return on his investment. Now, this is a tax deferral strategy. Cost segregation is not a permanent write-off. It's not a tax savings. So it can be permanent if you play the game correctly, but if you don't play the game correctly and you just do this and you sell your rental portfolio eventually, you don't keep reinvesting in real estate, well then, yeah, you owe those taxes, right? So this is the IRS lets you use the depreciation to offset your taxable income. They still want you to pay those taxes eventually, right? So if you, I think let's just say you what was it? It was the $600,000 property, okay? And yeah, you front loaded $120,000 of depreciation. So now your basis went down to $480,000. Okay. So if you sell this property for $700,000, one would think, okay, well, my gain is the difference between the $700,000 sale price and the $600,000 purchase price. I made $100,000. That's the capital gain. That's true, but you also still owe that depreciation recapture for the $120,000 you took out. So your gain is actually $220,000. Sounds terrible, right? Like, okay, well, now I have to pay this back. I owe the IRS money on it, and that's true. It's not all that bad though, for multiple reasons. One, there's ways to get around that, where you don't have to pay back that depreciation recapture, or you can offset it. So one is like, okay, if you keep reinvesting in real estate, right, you hold on to your portfolio, and eventually one day you pass on, and then your family inherits the property, your kids or whoever inherits the property, your heirs, they get a reset in basis. So that $600,000 property that you depreciated down to $0, and your kids inherit it and it's worth $1 million, well, their basis resets at $1 million. It's not like they sell it for $1 million right away. They don't owe taxes on that $1 million. Like they owe taxes on the difference between the value they inherited at and whatever their sale price is. So if they sell it a year later at 1.1, they'll capital gains of that 100 grand. So that's why people continue to invest in real estate. You can use a 1031 exchange. 1031 exchange just means you're not actually selling your property, you're just upgrading. It's like, hey, I'm not taking the proceeds, using a third-party intermediary. They're taking the funds, they hold the funds, and then I identify a new property and I reinvest it in the new property. And so I didn't actually get the money, so I don't owe taxes on that money. So that's one way, 1031 exchange. Another way, though, that I really like, takes the pressure off the 1031 exchange, is just you simply just keep buying more real estate, or you have more real estate. So like if you have multiple rental properties and you sell property A and you owe that capital gains plus the depreciation recapture. So going back to our example, you sell it for $700,000, you have $220,000 of capital gains. Well, you can use $220,000 of depreciation from all the other properties that you have that you've accumulated. This depreciation is stored up. use that to offset the capital gains and the depreciation recapture on the first one. So that's why people just keep buying more real estate. And that's kind of called a lazy 1031 exchange, because you're not rolling it forward, you're just offsetting it with more depreciation.
And for those at home that are keeping score on their scorecards, how about that scenario where Matt's friend has that $120,000 depreciation, but he avoided a taxable event on his income tax and may trigger a taxable event on his capital gains tax? Isn't capital gains taxed at a lower rate than his proverbial income tax? So it's still a win-win, right?
Yeah, absolutely, Lucy. You brought up a very good point. So let's say you're in the 37% tax bracket, okay, and you do sell this property, and you don't 1031 exchange, you don't go reinvest in real estate, you don't have depreciation to offset the gains, so you owe this $220,000 back, right? One, the capital gains, that first $100,000, that's taxed at your capital gains rate, so 15%, 20%, depending on where you're at. The 120 that you took in depreciation, the max recapture rate is 25%. So if you're in the 37% tax bracket and you get a cost seg study done and you use this depreciation to offset your taxable income, and you go sell it 5 years down the road and you owe that $120,000 back, well, it's better to pay a 25% tax rate in 5 years with the time value of money than to pay 37% on it today. So lower tax bracket plus the time value of money. Now there's some nuances in there, like some of the 1245 properties actually taxed. It's not capped, but the rest of it is. So there's some nuances in there. It gets a little bit tricky, but generally speaking, it's capped at either your taxable income that year or the max of 25%. So in year 5, if you're at a 20% tax bracket or whatever, 22%, then you're at 22%. If you're at 37, well, you're just going to pay 25%. Hopefully that wasn't
Matt,
too
you know what the
confusing.
nice part of this conversation is? If we lost track of the math, we just give Sean a call. He'll run us through it again.
Exactly. Hey, Sean, why don't you tell everybody where they can find you on the socials, or get in touch with the company? I know you gave out the website earlier, but what if somebody has a direct question? What's the best way for them to get in touch with you?
Email me, Sean@mavencostseg.com. So Sean, spelled SEAN, at mavencostseg.com. I've got a team, and we'll get back to you pretty quickly. Collect your property information. I'm happy to share my calendar link, and we can have a call that way too. Or just go to mavencostseg.com/liquid, and they'll get a discount there for going to that, and coming from you guys. But happy to chat with anybody, and to make sure this works for you and it makes sense. Lou, I was going back. I did kind of remember your question, and people do. Your question originally was about the strategy, right? Like, okay, well, like, do you save this? Do you do it now? Do you do it later? And a cool thing about depreciation is that the year you take it is what matters. So let's just say, like, you weren't a real estate professional. Like this guy that I talked to right before our call, he has 9 rental properties. He never did cost segregation. And let's just say average, he's had them for like 3 years on average. It varies per property, but about 3 years. And I don't know if he did or didn't, but let's just assume he did not qualify for real estate professional status those prior 3 years. But he qualifies, or his spouse qualifies, this current year. So he can do what's called a Form 3115, which is a catch-up in depreciation. It's a change in accounting method, saying, hey, IRS, like, we're not going to amend our taxes and redo everything, but like, we didn't do a cost seg study, and we should have, and we are actually depreciating these incorrectly, and we should have accelerated all this depreciation. So we missed this big chunk. And so we're going to take this $300,000 additional this current year, and because he qualifies for real estate professional status this year, he gets to use it to offset his income this year. So sometimes people will time things in terms of, okay, like I don't have it this year, but next year I'm going to have a big capital gain. I'm going to sell a different property, and so I want to get a cost study done on a different property to to offset these things. So it can get strategic.
Sean, let's geek out for the real estate guys in the audience. What is the most fun cost, if that's even possible? What's the most fun cost seg you've ever done?
I mean, some of these short-term rentals are really cool. Like it's just fun. They're really fun. Like you look at like what people, my mind starts going because I'm like, oh wow, like that's what I gotta do. I gotta like build one of those. So I saw there's one that it's small, right? And so it's not like, look, there's plenty of self-storage facilities and stuff, and like that's fun, but it's not like it's okay, it's another metal shed, right? Like no offense, I'm a self-storage investor, but like that's what they are. We're just renting out sheds. They're not that cool or fun. Like they're just good investments. Um, but this guy had a couple, like he bought a lot and right on Lake Superior. I'm in Michigan, I'm in Detroit. And so he was like, he's all the way up in like the Minnesota side, and he's on the bluffs looking down, and he built these short-term rentals, 2 cabins on this lot, and they're overlooking the water and stuff. And it looks amazing, right? And he did all the work himself, and not that big. I mean, they're like 500 square feet a piece, not even, right? And there's 2, but he has like built the sauna outside, just like really did it right, dialed it in. And some of that stuff is inspiring. Like I'm looking at that and I'm like, okay, so I don't live anywhere near Minnesota, but I'm in Detroit. Like I'm pretty close to Lake Huron, Lake Michigan. Like I could build something over on Lake Michigan, do something like that. So I mean, my mind's been going ever since I looked at that property like a couple months ago, and I'm like, all right, I got to sell this self-storage facility, and then I'll get a payout, and then I could reinvest in a short-term rental, and yeah. So
You
it's
realize what
cool to feel this.
you realize the domino effect you just created. I'm going to get like 14 emails from Matthew tonight with pictures of like Lake Huron real estate investments.
There you go.
No, my short-term rental days are over, my man. I promise you that.
Yeah, you're done with it.
I'm done with it.
Yeah, I mean, Orlando's a great place to have a short-term rental. My brother-in-law has one right there. It's a hot area.
Yeah. No, it was good. I had mine in South Florida, and it was a lot of work. I was managing it.
Yeah.
So it was a lot of work.
Yeah, they can be a lot of work.
It was definitely if you have the time and you have the patience to actually do it, or you set up a team to do it for you. I know some people that have a very, very great career doing it.
Yeah, I think setting up an internal team is really, really the key, in my opinion.
So Sean, thank you so much for being here. I want to be respectful of your time. I do have one question before I let you run. How scalable is the model for storage units?
What do you mean more specifically?
So if where are the storage units you're buying? Are you buying them in a specific geographic region, or are you trying to buy them all over the country and you're putting internal teams and operations in place to run everything?
Everything I do is internal teams and operations. We can do it all remotely. Mine are in Michigan and Ohio, so I have them in the Midwest. I love Florida. I love the Orlando area. I've looked at a lot of development sites down there. Problem with Florida is, of course, the insurance, just like anything else you're buying in Florida. I think the key is to get in the path of progress where you can get high rent. Obviously, you need to get high rental income. So there's different strategies, right? You could buy something small and start that way, and like it's just like really small, undervalued, undermanaged, and like turn it around. But I like the development side of it as well, where you're in that path of progress and people are renting climate controlled self-storage facilities, 10 by 10 units for $200 a month, right? And you'll see that all day in the Orlando area. So, I mean, it's definitely scalable. I think there's a lot more upside in development than there is in existing facilities. So once you're kind of under that 50,000 square foot threshold, you have a different buyer than like over 50,000 square foot. Then you're talking to more like regional players or like larger players. Once you get 70,000 up, you're talking about REITs who are interested. So if you can do it right and develop some, I mean, a lot of these REITs, they have money to deploy. They need to deploy that money. So if you can get in the right location and set it all up, then there's a lot of opportunity there. So, but that's not it. Look, if it was easy, everybody would do it at the same time. It's not necessarily an easy thing to do, but it is doable.
Absolutely. Sean, thank you so much for being here, man. Everybody, that's a wrap of the Liquid Lunch Project. We'll see you on the next episode.